Jinesh Gopani, founder of Taksh Asset Management, joining us this afternoon to give us perspective on everything that's happening with regard to markets, as well as how should one play it at this time. Jinesh, I'll allow you to answer that first. How are you playing this at this point?
Yeah, so thank you for having me on the show. I think volatile times, a lot to learn from what's going on in the global world. I think the best way to play is what we feel, at least given the global landscape is so volatile. I think best to play the domestic stories, B2C, where I would say that the oil, inflation, interest rate cut, all are, I would say, giving a lot of cushion to the domestic growth stories, at least for now. We'll have to see the second order impact, first order impact, any which ways, even RBI governor has said that it is not much of an impact from this global tariff view. But the second order impact, which is an unintended consequences, will have to be very, very vigilant. And the best way to play is the domestic stories, B2C, B2B domestic, very, very stock specific and less of exports.
And, and Jinesh, I wonder how one were to play domestics therefore. Where do you see both value as well as some bit of insulation from everything that's happening globally?
See, it's a relative story. At the end of the day, money has to find ways into investment in some of the other sectors which are going to report, I would say, better numbers versus the other sectors. So B2C, if you take the financial as a space, if you take the consumption as a space, and especially on the backdrop of improving macro, at least for India for now, where crude oil prices have come down, interest rates are low, is under our control. I think, and also from the budget point of view, have got some bit of a tax rate benefits coming into play. So all these bodes well to play into some of the stories which I just alluded to. At least from a growth perspective, if the second order impact is not very significant, then I think if a company is growing at 20%, they might end up growing at 18%, but it is not a situation where some of these sectors will just collapse. So this is the best way I would say play. Even some of the companies which have moat in their businesses have high EBITDA margins to take care of this onslaught of slowdown, if at all it comes. I think they are much, much better placed. Our entire philosophy is based on execution stories, and we always feel that India is land of execution, and if a promoter or a professional is able to execute, then there is a lot of scope for some of these scalable sectors where those companies are. So that is the best way to, I would say, play your portfolio, and that is what we have been doing.
Jinesh, good afternoon. Neeraj here. In your earlier venture, when you manage seriously large sums of money, you were amongst the few who used to bet on stocks even at higher valuations if the growth was there and the promoter quality was strong. We started to see some bit of that come back a little before these tariffs have hit. Now my question is, in domestic facing stories, if the valuations are expensive, would you still go out and buy into some of those right now? Or is it a very, very bottom up, very, very stock specific approach that you're taking currently?
See, it's a very, very stock specific approach, Neeraj, because certain sectors, certain companies, as I said, if you are in some of these scalable sectors, sky is the limit for growth. So you can always envision beyond 3, 5, 7 years kind of a growth trajectory for that company. Obviously, the strategy should be executed well on ground. And if you are placing your bets on some of the good promoters, good professionals, whose intent and ability is good, the capability is there to grow and grow at a faster pace than the industry averages, generally the valuation premium comes into play. So obviously, valuation is a function of growth, the ability to generate incremental ROIs, and ability to have some moat in the business. So all this coming together, if you are in the right story, I think there is a lot of wealth creation opportunity.
There is a mix happening, Jinesh, off late when I see the sell side notes. And a part of that mix is a flight to safety. There was a Macquarie note couple of days back, which said that, okay, they want to get into Airtel as a key flight of safety. This morning, suddenly people are saying that, okay, we want to get into companies which might be benefiting both from business doing well, as well as lower energy prices, for example. So aviation is right in the thick of things, right? A lot of those technology players there, or the tech players, their valuations have gone down. So maybe there is comfort there too in the dealing rooms. Where is it that you have the highest overweight within your portfolios, within some of the sectors that you spoke about?
Yeah, so as I said, we are playing largely more B2C as a theme, as global volatility is difficult to understand at this juncture. So better to play local, and that is where oil, inflation, interest rates are in your favor for domestic consumption stories to do well. So domestic B2C, more like financials, NBFCs, retail, consumption basket, is what the larger part of the portfolio is around. And also we have some positions in B2B, which is more domestic manufacturing and domestic selling, and exports have been less than 10% of the portfolio. So that is how we are placing our bets as of now. We will see how things unfold over next 1 to 3 month period. Also, the earning seasons is around the corner. So whether that gives you some indication of how to play some of the export stories. If let's say the concern is not that much, and there is a valuation framework which comes into play.
Yeah, Jinesh, the other piece is that there's, you've spoken about how you favor domestic-facing companies. There's been this huge change of stance by the RBI and more action than really stance and commentary. On the action front, they've eased liquidity, they've cut rates by 50 basis points now. Do you believe that there is merit in buying financials at this point, given that you might see margins come under some pressure and more pressure to transmit rates to the consumer?
Correct. So I think if you really see the financial as a sector, if you need, let's say, 10% to 11% nominal GDP growth, which is like real GDP plus inflation, you will end up having an industry credit growth of at least 10 to 12%. So you already have a decent amount of sector growth which is available for you. In that, if a company has a market share of 1%, 2%, or 0.5%, be it NBFC or be it private sector banks, I think there is clear opportunity if you play your cards well. Margin, yes, when the interest rates come down, generally the deposit side gets repriced later, and then you have to reprice your assets faster. So to some extent, there will be some margin compression, but the growth is available for you to grow. And as you rightly said, the stance of RBI is for pro-growth. The kind of liquidity they have pumped into the system over last 3-4 month period itself gives you a lot of comfort that they are in for growth. They want to ensure enough liquidity for the growth to continue as they would have expected on the local economy side. So yeah, I think there is huge scope, even if there is, let's say, 20-30 basis point shave off of margin. I think it is transitory at some point, and overall you have to look at how the asset quality behaves. If asset quality is good, then the return on asset is a better metric to look for, and if return on asset is manageable within a certain targeted range, then I think there is a good play around that.
Okay. Jinesh, last couple of questions. The first one is, there was a lot of, this market meltdown has hit a lot of pockets, but I'm just using names as an example. But everybody was very constructive, let's say on a Voltas or the cooling solution companies, and that stock which was at 1800, maybe at 1200 or what have you, right? So a lot of fancied themes which are believed to be no-brainers. FMCG, 12,000 rupees in the hands of the consumer. So some of the discretionary and staple spend, both of them will rise. Tourism will rise, etc., etc., etc. It hasn't quite played out that way from a stock price perspective. Would you still believe in the veracity of the theme that 12,000 rupees with a consumer means discretionary spend could go up? A hot summer, which may mean that some of the cooling solution products could do well. Again, some of the ordering activity, quick commerce, etc., could do well. Do you still believe in that fundamentally?
Yeah, so as I said, Neeraj, that maybe there might not be the intensity of growth which is higher than last year, but at least there is a growth, right, at the end of the day. And obviously, one should not forget there is a lot of competitive intensity also at play. So just when we are doing our checks, I think clearly in the cooling solution side, there are close to 25, 30 competitors when you go to the store and look at it. And the different geographies will have different brands, local brands, and also some of the national brands. So there is a lot of competitive intensity also at play. And to some extent, I think we are just the start of the summer season, and still it is early days to call for whether there will be a huge growth or whether there will be a sort of a sedate kind of a growth. But there is growth. So obviously, because of the high valuation, a lot of money chasing some of these stories, because we have got a lot of money in the mid and the small cap side from the fund flow perspective over last 2 year period. I think there is some shave off which is taking place. So too early to tell you whether it is the growth rates are good or not that great, but yeah, there will be competitive intensity which will play a role.
Got it. Okay, one last question from my end. When do you think this turns? Because it seems like a slightly long drawn battle. So would you believe there will be enough time to accumulate businesses over the course of the next 3 to 6 months? Again, I'm not asking you to tell me the timing of the market, but broadly, is that a safe thought?
Yeah, I think so. If you really see, Neeraj, what is happening is it is sort of a global supremacy game. So it is not that I am doing this, you come on table, and from next day onwards I will reverse everything. So I think it is going to be a bit of a long drawn process. It is like a global tariff war. We all know the war is between two large economies. Uh, Hopefully, we should not be getting impacted so much. So it's a bit of a long drawn process. You will get enough opportunities in next 2 3 month period to understand who is getting impacted, who is not getting impacted, which sectors are better, which companies are stock specific will do well, how the unintended consequences will hit some of the companies or not hit some of the companies. So there are too many factors at play. Markets are going to be a bit volatile, maybe in the range of certain level, but they are going to be volatile. Money will pivot from some not so good stories to some good stories. So all these things will happen over next 1 to 3 month period. Along with that, you have an earning season coming into play. So people would wait, investors would wait for some commentary coming out of from the corporate world. Especially people will look at tech and pharma sector, how they react to the commentaries and the results. And I think we can take an informed decision if you are looking at 3 to 5 year perspective.
Point taken, Jinesh. Thank you so much for coming in, speaking with us, and giving us that perspective. Uncertain times.
Pleasure. Thank you.
And always good having that perspective. But thank you so much.